an investment background, that will help. Any investment material that you have taken, courses, exposure, experience, whatever you have, it will certainly help learning this course or learning this put writing material. The objective of this course, surely I will go into a bit of theory, but my focus would be hands-on. And one thing I'd like to make sure that this course itself will not make you an expert. This course will push you to learn, to start trading. And then depending on what you already know and depending on how much you experience it through your day-to-day trading, that will help. If you want to learn this course and take best advantage, I would say that assignment is kind of mandatory. Unfortunately, it's not 2 weeks, and my next part of the course is only 1 week away. So there is, for you folks, it's only 1 week. Today, what we will discuss, what is a put option? We will take some examples of it, understand how put contract works. We will study from a seller's perspective, the put contract. We will see how we can read put quotation, put quotes, how to trade. I will take you to my live brokerage broker's screen share, and I will put in one trade for you to see that if you can basically able to learn and pick up how to do it. There will be more slides on why sell put, and I'll try to convince you to do the assignment and start trading. Assignment is around actually doing some trading during the week on paper. Session 2 will be assignment review and recap of the first session. We'll look at the put returns. We will deep dive into, once you have traded put, how to manage your put position. We'll look into risk management. There will be some trading tips and my style of how I do it. And of course, there will be a conclusion on it. There is an assessment as well in this part of this course. Every day, 9:30 to 4 p.m., Monday to Friday, 52 weeks of the year, you can sit in the exam, New York market, and there will be a grade sheet that comes from your brokerage house. And just on the lighter note, I take this exam every day religiously and would like to have some more challenging sessions in my daily activity. I would like more people to start doing it. Before we get started, this is the chart that I pulled last Friday. It's not yesterday's close. It was yesterday when I first presented. The Apple stock, which is a very common among investors, especially individual investors. This is a 6-month chart going back to November of last year. It closed yesterday. Apple closed, sorry, a week from yesterday, it closed at $127.45. If I tell you that this put writing strategy makes it possible that you can get Apple stocks not at 127.5, but at 110. It never traded at 110 in last 6 months. But if I tell you, you can get it for 110, most of you, I believe, would say that you will be interested in getting the stock for 110. Let's say if you are still on the fence and thinking whether it's a good offer or not, if I tell you that you show commitment and a serious commitment of getting Apple stock at 110, I'll pay you $1 per share from my pocket. Would that change your mind? That if you commit to buy Apple stocks at 110 a share, I will give you $1 a share from my pocket. If that convinces you, then I'll tell you a good news. This put strategy, which you're about to learn, makes it possible, whatever I said for this slide. At the end of the course, I'll ask you guys to explain me how this is possible. Put writing. Put writing, which is also another name of put selling. And why it is called put writing? Because we are writing a contract or we are selling insurance. And in insurance, we call insurance being underwritten or being written, or insurance contracts are being wrote. Put selling is the same way, is a term used for put selling because we sell contracts. The strategy is to create an income via collecting premiums. The way insurance has premiums, the same way put selling or put writing contracts also have premiums. Put writing is very much like insurance. And to understand put writing, I'll take an example of insurance contract, and then we will look into put writing. Let's say you have a house of a $1 million and you would like to insure it. You went to insurance company, you got a first quotation, value of the house is 1 million, contract is for 6 months, and 6 months premium is $2,000. The deductible this insurance company is asking is $25,000. This is the crux of an insurance quotation. You think 2,000 is pretty expensive for insuring a 6-month contract. 6 months insurance is very expensive. You went to another insurance, and let's say you come to me, and as an insurance company, I'm giving you a quotation that I can give you a premium of 1,000, still property value is 1 million and it's a 6-month contract, but deductible will be 50,000. What is a deductible? Deductible is the buyer of the insurance covers the first portion of the deductible, portion of the insurance, which is called deductible. So in quotation 1, buyer covers 25,000. In insurance quotation 2, buyer covers 50,000. Let's say if you go with second quotation because premium is less and you would like to save some money. Down the road, within the 6 months, something happened to your house. Your roof has a damage and it costs you 30 grand to fix it. What will happen? The buyer of the insurance, the owner of the house, has to pay full 30,000. I, as an insurance company, will have to not pay anything because the deductible is 50,000. And buyer agreed at the time of the insurance that he will cover the first 50,000 if any damage happened. So in this contract example, what we learned is that buyer is basically still paying $1,000 in premium and the damage, whereas the insurance company simply keeps the premium of 1,000 without paying any damage. Of course, if the damage goes to 100,000, insurance company will pay $50,000 after the deductible. But as long as insurance is still intact. Looking at this example from an insurance company perspective, because they are selling the insurance, how insurance company makes money? Insurance company makes money through the premium they collect. As long as there is no claim, as long as claims are small, deductible is high, and overall total insurance premiums they collected minus sometimes they have to pay some claims is positive. That's how insurance company makes money. As I said, put selling is like insurance company. You are taking a seat or role of an insurance company and selling puts. Put is a commitment given by a put seller to the put buyer. Like an insurance company, when they sell you an insurance to the buyer of the insurance, there is a commitment. If something bad happens, if something really bad happens, they will fix the house, they will reimburse you. If it's a car insurance, they will fix the car or give you the money to buy a new car. Always, put seller receives the premium against the commitment. I'm making a commitment by selling a put, and I will get the premium. What is the commitment of the put seller? The put seller, when it sells the put, commits that if something bad happens to the shares, underlying shares, the put seller will purchase the shares at a predetermined price. So put seller becomes an insurance company and always receives the premium. Put buyer insures the stocks but pays the premium. Important thing to understand here, put seller receives the premium for a commitment, and the commitment he's making is that the put seller will purchase the stocks at a predetermined price if buyer of the put chooses to sell or claim the insurance. Very important here, before I confuse you, we as a put writer or a put seller, we are an insurance company. We take the role of insurance company. We sell the puts, we receive the premium. Whatever premium we receive, we keep it in our pockets. When there is no claim, when put buyer doesn't claim anything, premium is ours to keep. The whole idea of this strategy is to sell puts, to receive premium, and to ensure that our commitment is called upon rarely, not too often. Very seldomly we are called for our claim. And the way insurance company manages their risk and ensures that they write less risky insurances where the chances of keeping the premium is high, that's what we will do in our put writing. On the other side of the contract is the put buyer. Put buyer wants to insure his shares. If he buys Apple shares or Tesla shares or some other shares or ETFs, ARKK or S&P 500 or QQQ, NASDAQ, whichever shares or ETF he wants to insure, he will basically look for somebody who can sell him the put insurance. Now let's move towards put writing. Now that I have explained the contract and the premium and the put selling aspect, let's look at the example of a put. A stock is trading at $45 a share. We, as an insurance company or put writer, we sell a contract to a put buyer that I will buy your shares for $40. Market is trading at 45. We are insuring $40, and I will take $3 of premium per share. So here, there is a deductible. Not very clearly mentioned, but there is a deductible. Market value is 45. Strike price or insured amount is 40. This $5 is deductible. If market remains between 40 and 45, the buyer of the insurance or the buyer of the put will cover it. It's like a deductible of the insurance. Insurance company or put seller will not be called upon because we as put writer have only insured $40 for a share, and $3 is our premium to keep. No matter what happens, $3 is sellers to keep. Okay. Your commitment as a put seller, I'm just repeating here. So one last time, so we get the idea of how put contract works. Your commitment is you will purchase the stock from the put buyer at $40 within 6 months. And after 6 months, the insurance expires or the contract expires. For this commitment, you will be receiving $3 a share from the buyer. The deductible here, which is like your risk protection, is $5. It's up to you. You can go up to 35 and deductible will increase, but premium will decrease. As we saw in insurance, as deductible increase, the premium decrease. If you remember my first example of a house insurance, if deductible decrease, then the buyer of the insurance company has to pay a higher premium. So if we go to 42 or 43, we will not charge $3 in premium. We might charge $4 or $5. At expiration, 6 months later, when the contract expires, if the stock price remains above $40 a share, the put seller will just keep the premium and nothing will happen. Insurance expires the way your house insurance or auto insurance expires without any claim, and the insurance company keeps the premium the same way here. As long as in this example, the share remains above $40, the premium is yours to keep. If there is a drop in the stock between 37 and 40, you will lose part of the premium, because buyer of the put may ask you, here is your commitment, please buy the shares at 40. So $3 premium is basically covers you from $40 to 37. If stock price remain between 37 and 40, you might lose some of your premium back, but you will still keep some of the premium. Your total loss will be below 37. If market goes to $30 a share, of course, you will have to purchase the stock at $40. That is the put contract and put contract consequences at the end of 6 months. To repeat here, and after this repeat, I will take some questions before we look at the other example. The put seller sells a contract. He commits that he will buy the underlying shares at the strike price. Strike price was 40 in our previous example. The put buyer pays the premium to the seller and gets the insurance that his stocks are covered at the strike price. Any questions here? I'm making sure that you understand all the lingos, because when you do day-to-day trading, and especially when we will next Saturday talk about more advanced topics, is what being insured. In put writing, a stock is being insured. Contract expiration date is basically insurance expiration in insurance world. Strike price is the insured amount or the claim amount. This is what you have to pay if buyer asks you to take the shares. Premium in insurance and in put writing, it's the same. Deductible in insurance is the stock's current price minus strike price. As you, Christian, you asked, contracts are always in 100 size of hundreds. It's not 150, it's not 50, it's not 2. They're always in 100 shares. So if you write one contract of put, it is basically 100 shares of the underlying. When the buyer wants to sell the shares, it's called exercise the put. So the word we will use is put got exercised, which is basically in insurance buyer is making a claim of the damages. So exercise the put. There is another term which I sometimes use, which is exercise the put. From the put writing perspective, is basically, we call it assigned. When the put buyer exercises his put, he sells the shares to the insurance company or to the put writer, and put writer gets shares assigned. So in that example, and which Valentin asked the question, the premium is yours to keep always, but $40 a share is assigned to you and you have to pay for it. And then you can choose to keep the shares and wait until it goes back to 40, or you can sell it right away at 37, 38, 35, whatever it is, and start moving to the next put contract.
I have one quick question.
Sure.
For example, if the share in the case with the 40 and 45, if let's say yesterday it closed at 42 and today opens at 35, that's what you're gonna pay for now, the 35?
No, you are a put writer.
Yeah.
You will always, because you have written an insurance of $40,
Oh,
you will
okay. So you
always
always
have to
get
pay
the
40.
40.
You might turn it around and sell it for 35 because the market is now 35, but
Okay.
you will always get $40. You
Okay.
always have to pay 40. I just want to see in participants if there is anybody from UK. No, I don't think there is anybody joined from UK, because UK puts as a one little difference. Since there is nobody from UK, I'll keep going. Put terminologies, we looked at it. Contract is, we will call it one contract, but we always mean 100 shares. Exercise and assignment are the same thing. Exercise is done by the buyer. It gets assigned to the seller because seller has already committed to the strike price. Now, let's take the example. This is more, first was a made up case. This is Apple shares. Let's assume today is Monday and trading at 1:30. We sell a put expiration for this Friday, same week, like just 5 days, with following attributes. Expires on this Friday, means 5 days contract. Strike price is 120, and we only get 50 cents for a share. So number of shares, since we are only selling one contract, it's 100 shares. What is the deductible here? Deductible is $10 because market is, Apple shares are trading at 130. Our strike price we have choose is 120. So there is a $10 deductible. As long as Apple shares remain above 120, we are quite safe with our premium. Our risk though is 120 multiplied by 100 shares, $12,000. This is what we have to buy in case we are get assignment. Profit, of course, depends on what happens on expiration. If the shares remain above 130 or even above 120, the $50 that we got in premium, 50 cents a share times 100, is ours profit. But if now market goes south of 120, and let's say here it goes to 110, we have to buy the shares at 120, which is $950 loss. But that is a theoretical loss to previous question. We can basically sell it and materialize the 950 or limit the 950, or keep the shares at that we bought at 120 and let market come back at 120. In that case, $50 is yours to keep, and for whatever weeks you have to keep the shares to wait until it goes back to 120. So that is more realistic example of Apple trading these days. Seller of the put has the obligation to buy the stock at the strike price if and when buyer exercises the option. Seller keeps the premium no matter what happens on the day of expiration. Buyer must exercise his option of selling you the shares on or before the date of expiration. Please remember, in US stock market, 4 p.m. Fridays is usually the day end. It closes on Friday and it ends at 4 p.m. Extended trading hours does not apply to option puts. So if somebody wants to exercise, has to exercise before 4 p.m. It will get assigned to the put seller later in the day at the closing. Of course, buyer has the right to exercise. Buyer can choose not to. Sometimes it hits 120 in our previous example, But since buyer has already paid premium, he might not exercise it. He might still feel that what would I do if it's 120, because I've already paid the premium. So my cost is still higher than 120. So he might not exercise it. Here I'll just take a few more questions after this Apple example. And the next session is more on how to read the charts. And we'll get into that next. But if you have any question here on the theory on how the commitment works, if you have joined just now, you can please go ahead and ask your questions. Unmute yourself if you're asking.
Christian again here. What's the minimum time limit for a contract? Is it like a day, a week? Like, is there any limit?
Contracts for most stocks expire weekly.
Oh, okay.
There are a few very ETFs which are not very high volume on options, very low volume options, only have monthly contracts. But you as a seller, and I do this, and I will tell you in my part 2 how I use this strategy. Tesla, I am a big fan of Tesla, but I know the risk of put writing. I usually write Tesla puts Friday morning on the same day expiry. Because I don't want to take a lot of risk. I don't know in 5 days Tesla can go from 700 to 600. So I don't write personally Tesla stocks put for more than a day or two. Maybe sometimes I'll write it on a Thursday. I'll take 2 days risk on it and collect the premium. But if it is a Apple type of stock, I would keep it for a week, 2 weeks. If it's a Pfizer type of stock, I would keep for even a month out, because premiums are very low and it's not that volatile. But you can choose. If contract expires a week from today, you don't have to write it today. You can delay it until Tuesday, Wednesday, and take only the days when you think it's now safe for you to write the put and keep the premium. Okay. And the session 2, we will go more into selecting the contract expiration date, the strike, and a little bit on premium.
Okay, thank you.
Thank you, Christian. It's always good to ask some questions, so it gives me a little feedback as well that people are understanding what I'm saying. Anybody else? No question? Okay, so I'll show you how theoretically a put quotation looks like. When you look at the put chart on your broker or on Yahoo Finance or Google Finance, there will be an expiration date. May 7th is the expiration date here. Sorry, it's a past date. And this is an Apple puts. So every contract name starts with Apple. 21 is basically the date. 05 is the month. 07 is the day. And then there is a put strike price of 65. So everything which is I'm going to say is in the put contract name. May 7, 2021 is the expiration. Puts is on 65. I took this chart detail from on May 7th closing day, just before I plugged it in. And since the actual price is so high, the premium price, if you see, is only 1 cent and 2 cents. But this is how the chart is read, that there will be a last contract price, that what it sold for. There will be a bid, means buyer is willing to pay, and ask price, which is what his seller is willing to commit to. So these are the premium price. This is what you will get. One contract, as I say, will give you 100 times of this premium. So 8 cents means $8 for one contract, because that's the price. Now I will take you to my own trading. First, I'll show you, this is the real trading screen. And I don't remember the stock. But once I change it, I can. So I hope you can see my live screen. So here is the put trading. Puts are on the right. Left side is calls. Calls is a subject of discussion for another day. We will focus on puts. Market is trading at 127.31. That's the price at top. That's the Apple share. And if you look at this left side top, there are bunch of dates. May 28th is the expiration of coming Friday contracts. June 4th is the following Friday, June 11th. So over here you will select, let's say you select that you are writing a contract for this coming Friday, which is 6 days from today. And you decided that you will write it for 120 strike price. When you will decide for 120, right now it's trading at 31 and 32 cents. So you will either get 31 or 32 cents Monday morning. I don't know now. This is, some of you may not be using the same broker. You might have a different broker. My broker allows me to right click and click sell. When I do sell here, I go to the screen, which is basically mine, and I can write it here, sell one share, one contract, which is 100 shares at 31 cents. I'll just be like Christian. I don't want 31 cents. I'm a little greedy. I want 35 cents. And this is my live. So as soon as I submit, it will go to the exchange, and Monday 9:30, it will get executed. So that is what, and if you see down here, my contract has just come, waiting for it to be delivered. So that's easy it is to look at the screen and do it. But of course, if you have never done this before, you might need some paper account to do it a couple of times and be able to trade it. What I have done is that I have removed from my screen a lot of other things, which is open interest, which tells you how many contracts are already out there between different buyers and sellers, 7.57K. So yours will be another one top on, or mine will be on top of this 7,057. Okay, so that is a short illustration of it. Any questions here?
Is the volume, I assume the maximum can go to the number of open options, correct?
Not really. 7.57 is cumulative over time.
Oh, actually, yeah, I see now that there are higher numbers below. Sorry.
Yeah. So open volume could be 5, volume could be 0 today, but 7.57 because nobody is traded today. This volume is of Friday's volume, but Monday morning this will start from 0. Volume will, of course, 9:30 there will be very few volume, but 7.57 contracts are there. If my contract gets executed, volume will turn 1, and open interest will, because it's a new contract, open interest will be added to 7.57.
Yeah.
But you have, someday in time you have to look at it, because if I go at the very top and say, okay, I will buy Apple stocks at 90, there is no volume today. Nobody is interested in ensuring their Apple stocks at 90. Okay. So yes, you can put an order. I can put an order. The chances of it getting executed or me finding a buyer is almost 0. But I might get some at 100. And even 100 for 6 days is pretty, I'm a very low risk put writer. At 110, there is a volume and there is an open interest. I might be able to get 5 cents a share, $6 for this trade. And most likely I will keep the premium in my pocket, assuming that Apple doesn't go from 127 to 110 in 5 days. So that is what we are doing by selling puts and how we generate money. And I know this particular part of what I'm showing you, how to read a chart and how to put a trade, is where it's mechanics, but many people do get confused. And my assignment, as you will see in a few minutes, is around this, that you will basically have to do one trade, real trade, put paper trade, whatever you like. Okay, let me go back to my.
And where in Canada, where can we open like a paper account?
Paper
But-
account, I'm not sure. If you have an account with your existing broker, they will give you a paper account. I think, or you can also write far out of the money. When I say far out of the money, I mean, you can write a put for 90. It will not get executed. If you have
Yeah.
a real account, you just write it at Apple's share for 90. And if you are very scared, don't even write 90 on Monday morning, write it on Thursday morning or Wednesday morning or Friday morning and learn it. But we are moving towards the conclusion, and you will see the assignments, assignment of this course, not put assignment, is that basically I've asked you to do one trade. So when you come next Saturday, you're familiar with the lingo and you're familiar with the way to trade. So we can look into some intermediary and advanced concepts of making money and how to write and tips and how to manage your positions, as opposed to initiating, which is the focus of today's discussion.
Okay.
Anybody else before I start my conclusion? And in the conclusion, there will be, of course, some new ideas, but mostly it will be a repetition of what we just covered. Okay. So put contracts behave like insurance contracts. That's how you have to look at it. You are an insurance company. And if you are a Canadian auto insurance, if you have bought or have shopped for auto insurance, you might feel good right now that I can also be an insurance company and be able to make money out of put buyers. The consequence of claim requires you to buy the shares at the strike price, because that's the promise. And remember here that your broker will block your money, not fully, partially. And if it's a registered retirement account, fully, it has to be a cash deal. They will block it. So you should have some cash to write the puts. Before expiration, if stock closes above or equal to the strike price, you are in a profit no matter what. Your premium, you will keep it. To minimize the claims, keep the deductible bigger. To minimize the claims or assignments, keep the expiration date shorter. These are the tips of the insurance company. A one-day auto insurance will be, of course, less risky, and it's in the interest of the insurance company. Why we do write puts? There is a safety net to it. There is a deductible between the market price and the strike price. There is a premium that you keep, which is your safety net. And this is a very important thing. Try to write put on stocks that you like to buy, willing to buy at the strike price, as opposed to you go and write you are a person who likes financial or value or Walmart or Home Depot or Enbridge type of stocks. But then just because of this, you start writing stocks of cannabis or technology or Tesla. Don't do that. If you are not in your comfort zone, don't go out of your comfort, because you write, I'm sure you have gone to insurance company and who say, we don't write insurance for you. We don't write because you are driving a Ferrari or driving a very luxurious car. We don't cover luxurious cars. Or there are sometimes insurance companies say we don't cover first-time drivers or drivers under the age of 21. Why do they do that? Because that's not their market. Same way, if it's not your market, don't just because you took this course or because I'm telling you it's a good income stream, don't do that. Write the stocks that you understand, write this on the stocks that you like to buy, write the stocks that you know how up and down they go. Another important point is time is on your side. If you just wait until expiration date patiently, you earn the premium. When you buy the insurance, and those of you are familiar or who have worked in the insurance company, when somebody pays the insurance, this is my 6 months, $1,000 insurance, the insurance company by regulation cannot claim that 1,000 as income or revenue. They earned it. It's like they're in their cash book, but it's called unearned income. Every day it passes, the unearned income becomes an earned income. Let's say if I buy an auto insurance today from TD Insurance or Qatar Financial or some insurance company, and for whatever reason, I have to travel to India or I have to travel to East Africa, and my car now is sitting in the garage. For an insurance company, it's like a contract, all the five, everything is on his side, because insurance company is just basically making money as long as car sits in the garage. I'm not driving it. Insurance company is just waiting for its expiration and keeps the entire premium as an earned premium. And that's how you will make money. As long as Apple stocks trade above the market price when you sold the put, if it starts going north, you just wait for it and the premium will become from unearned to earned. The put seller, it has an advantage of time. Put buyer has the disadvantage of time, because for him to execute the claim, the time is running out. There are less and less time when he can execute the contract and have the basically claim. So that's why I like put more so, writing puts more so than buying any options. The assignment before you come next week is, as long as you're still interested in coming next week, is do one paper trade. If you have an account, you can ask them to open a paper account and you can do one real trade as well. If you're familiar or if you have done some in the past, maybe a covered call or maybe a put buy, you can do it one sell, and you don't have to do a very aggressive. As I said, you can use a 90 or 100 strike rate for a couple of days, or you can even do Tesla. Right now, Tesla is trading around 580. You can write it at for 500 or 450 on Friday morning and collect a few dollars. This is the second assignment. Sorry, this is question 3 of the assignment. 1 was the basically doing a paper trade. 2 was optional. If you have a real account and you're comfortable, do the real trade, put, sell. This is the graph where certain things are mentioned. There is a strike price line, there is a strike price. You have to be able to explain this graph to yourself, what it's trying to tell you. That's assignment, and I will send you these slides to those who are registered in last week. And the premium above is the 4th question. Like I have mentioned profit and loss and many things on this. I have not mentioned where is the premium. Can you, after explaining this graph to yourself, can you identify where is the premium on this? This is the assignment, and it will, these 3-4 questions will help you learn the basic of puts. Next week, before we end, I'd also like to mention you what's the next week's agenda. We will take it from the assignments. We will do a recap of what we studied today. We will then look at premiums and price movements. We will look at how to select a strike price and expiration date and premium. We will look at the returns and capital requirement when you write the put. And then once we have written the put, how to manage our put position, how to manage our risks, what are the trade-offs, and then towards the end of part 2, we will do a course and summary, and that's when we will end. We will try to spend most of the time next week on managing the puts and how to select some tricky things of the contracts, being the strike price, expiration date, and premium. I'll take a few questions and then we'll end the day. Please go ahead.
Question again. Someone told me that, for example, you can use only margin accounts. I have that with, let's say, TD.
Yes and no. You don't, if it's a retirement account, most brokerage houses allow you to write and puts, but of course you cannot write on margin amount. The whole money, like in the example we did of 120 strike price, the whole $12,000 will be blocked on the retirement account in this example that we did. But if it's a margin account, in cash account, you cannot do it. Like if it's a non-registered account, I should say, in non-registered account, it has to be a margin account. And then this, for this 12,000, most brokers will only block your $3,000 because they will be willing to give you $9,000.
So you have to have the $3,000 in cash now.
That's right. They will block the 3,000 and they will give you the 9,000 should there be a need. Now, where do I get this 9,000? Because for Apple stocks and for most stocks that are like Apple, it's 25% requirement. But if the stock happens to be $5, I think there is no margin. You have to have a full amount. Most brokers will not give you any amount of loan for stocks that are trading below $5. And stocks that are not blue chip but happen to be $20 or $30 or above $5, they will not give you 25%. They sometimes give you 33% or 50%. So if a stock is a very risky stock or a low profile stock, happens to be trading at 120 today, but it's not a blue chip company, they might ask you for $6,000 because they think very soon this stock will start trading at 6,000.
Okay, so
it depends, of course, on brokerages, but it also depends on government laws. That is 25% minimum margins, and for stocks that are $5 or less, zero margin.
So pretty much it means that you have to have cash in the account when putting the put, when you write the put.
Yes, and think from this perspective that you and I are becoming an insurance company without going through any regulatory requirement. And this is a promise. In regulatory requirement, when I say when there are house insurance companies and auto insurance company, they have gone through a regulatory requirement and they have given some money in some countries. They give the money to the government as well, just in case if they go bankrupt and if they run out of the country.
Yep.
So this is something like that, that no matter what happened to you, you might be traveling, you wrote the put and you are busy in your life, the broker will take care of your contract. If you only have 3,000, broker will pay 9,000, and then broker will not, because you are using broker's account, right? So broker will fulfill the obligation on your behalf, but that's why broker wants you to keep some money with him, and they block it.
Yeah. No, like
because you are becoming an insurance company, so they have the right to block some money. And when the stocks, let's say if the stock goes from 120 to 100, and broker has given you 9,000, they will now start asking you to pay some money, which is called margin call, because they are seeing that your 3,000 is diminishing and soon you will start eating into their money. So before it goes to 9,000, they will want you to chip in some more money as cash.
Yeah, no,
But
my
that's more
thinking.
between you and your broker.
Okay, my thinking was that if I have other investments, for example, I can sell another stock right away just to pay off, or consider that as like collateral, for example.
No, they will consider that. So
Okay,
that's why if you only have 3,000, they will start calling you very fast if you have no other investment. But if you have $200,000 of stocks,
exactly.
they will give you a few days and they will say, if you don't add more cash to it, we will start selling your securities.
Oh, okay, yeah, because
Okay.
I didn't want to just keep cash there just waiting, so I think I can always sell another stock if I'm ready.
Yeah, but they will give you a lot of loan for the stocks that you have, because they know that you have 100,000 or 200,000.
Exactly. Okay,
Yeah,
that's good.
yeah.
Thank you.
But and if you are trading, this is all the discussion on the margin accounts, which most of you will do. But if you are doing it on your RSP account or registered account, the only thing is that it's basically you need full 100% cash. There is
And
one
can you do it
question.
in TFSA? Sorry, the last question, and then.
Sorry, there is another question from someone, and it says, who are buying the put? So I'll answer this question very quickly, and we can again in second part we can ask this. People who would like to insure their stocks. There are retired people out there who, I'm not sure if you have heard of segregated mutual funds. They buy these mutual funds or this type of puts because they are close to the retirement and they don't want that in their retirement days Apple and Tesla from 120 goes and trading like 60. So they pay some little extra to guarantee that our stocks in our retirement days are protected at 120. But there are out there traders as well who are like insurance company, like you and me. They are selling their insurance, but have you heard the concept of reinsurance? That sometimes insurance companies sell you an insurance for your car and a house, and they sell it to another house owner. And then when they have hundreds or thousands of houses, they feel that if a flood comes or if a terrorist attack happens, or a building crashes, then entire building I have to create, and that's such a big insurance, I will go and get a reinsurance. The same applies here. If I am taking a lot of contracts of Apple and Tesla, I sometimes turn it around and not want at 120. I might go and cover myself at 100. That if something very bad happens from Apple from 120 to 80, I will only be on the hook from 120 to 100, because then I'm also covering myself. So when you sell it for 120, this could be a retirement buyer. This could be another seller who has sold it at 130 and wants to cover himself at 120. So you are covering it at 120, and you are now covering yourself by buying at 110, and somebody who sold you at 110 will be buying at 100. So there is a chain. You will never know who the buyer is. All you have to see is, are there buyers? And this is the screen which will tell you that how many buyers are out there, right? So of course, there are buyers for every seller. Buyers are there, and buyers are insuring it. Buyers are protecting themselves at a lower strike price, and there could be many reasons. But if you go into this area of 80 or 75, you might see there are no buyers because nobody is interested. So that is a worrisome place to be in. But if you are in 100 and up, there is a buyer for this particular stock. Yes, Christian, go ahead.
Yeah, so I was asking about whether you can do this in TFSA.
I think so. There is no stopping from, unless brokerage houses do not allow you, then there will be some issue, but most brokerage, and I use Interactive Brokers for the most of the time, and they allow for all kinds of accounts. TFSA has one restriction, of course, is that usually it's less than $100,000 unless you have been playing a lot of stocks. For like, if you have a lot of bigger TFSA account, then you probably can write it. But one or two puts will only be $10,000 or $20,000. I would recommend that if you are after this course, if you want to adopt this put writing as a core investment strategy like me, then select the broker that has a lesser commission. Don't go to brokers like TD and big banks, because they all charge you $10 or $6 per trade. Go to Interactive Broker, which charges you $1. Go to some other brokerage in US, Fidelity and Charles Schwab, which they all charge 65 cents a contract. And those are the cheaper, because you will be selling a lot. And for $50 or $70, or in this particular example that we were looking at, it's only $32 a contract. If you pay TD $9, then it doesn't make a lot of sense for you to keep only $22 out of 31, and they keep $9. So look for a broker that is cheaper. Look for a broker, if you're using the margin accounts, look for a broker where margin interest rates are smaller. I'm not a selling Interactive Broker at all. I use Interactive Broker, and when I searched my brokerage for this trading, I looked at only two things. One was commissions, which is $1 a trade or $1 a contract. And the other thing I looked at, if I happen to use margin, their margin rates are around 1.7 annualized interest rate, which is very low and very competitive. In Canada, you get mortgages of that level and they give you similar interest rates. So if I happen to use my margin loan amount, then interest rates are also less in a major investment broker.
It's good to know, and by all means, I'm not married to TD investing. It's just that's what I've been using so far. Because
okay, no, I guessed it, because most of us, I started my trading in '97 with TD.
yeah,
I moved on. I moved on mainly from the commissions, and then I have a secondary as well, because if I can't use Interactive Broker on a given day, I have a secondary, which is HSBC I use. That's also on the higher side, although it's $7 $6.99 is their commission. But still, I only use when I have to trade, and Interactive Broker is not allowing me to trade, or is down, or something like that.
So you use Interactive Broker for trading stocks as well as?
Mostly.
Okay.
I have never seen it so far going down during the timing, 9:30 to 4, Monday to Friday. I've never seen it down. And so that's what I use.
Okay.
But please, by no means, I'm not here to sell Interactive Brokers. They don't pay me commission or anything.
No, a friend of mine was using it. I know he was buying, I think, historical data and running strategies on it and stuff like that.
Yeah. So that concludes. If there are no other questions, I'll be sending you all the slides from today's session, and please make sure you take out a few minutes for the assignment if you are coming back next week. And looking forward to seeing you all next Saturday, same time. And I will surely send you the link again, so it's handy.
Yeah.
Bye, and have a nice week.
Yeah, thank you very much. It was very informative. Have a great week.